Banks have been running up a wall of worry over the last couple of months, and they may be ready to slide down a slope of hope. If you don't watch it, you could lose a finger trying to catch a falling knife in this sector. I'm going to pull apart the news in the regional banks, as well as look at some of the charts, so that you can actually navigate the volatility that I'm expecting to see over the next couple of months. First off, let's talk about the news last night. Overnight, we saw that Moody's actually lowered their ratings on a couple of banks, and this is on the debt of these banks. I've got a list of them up here. You can look at the top portion and see those companies. Names like MTB, M&T Bancorp, Associated Bancorp, ASB, WBS, Webster Financial, and also Prosperity Bankshares. Now, these are some of the smaller companies that are in the KRE, the regional bank ETF. These are small to medium-sized banks, and usually there's a nice little reach, but they are regional companies. You've got some of the other companies that are on the second part of this list that I'll get to in just a second. But the top part of the list, we saw Moody's downgrade the debt on these companies because of their balance sheet. So they're actually looking at what makes these companies operate and what makes them profitable and seeing some risks down the road. Now, let's compare it to two different things. First of all, I want to compare it to what happened with the United States government debt last week. So Fitch came out and they downgraded the US debt. The market pulled back 2% in one day and then seemed to recover from that very quickly. There's a specific reason. I even wrote something and gave you a video on that last week, and that is that debt downgrade is not as big of a deal. It feels like it's huge, but at this moment in time, it's a little understandable, and it's something that we've seen the market overcome before. So when you look at the U.S. downgrade, it is because of the people that are running the show. And what I mean by that, it was Fitch looking at our politicians right now, our regulators, and saying because of the polarity between these regulators, the absolute inability or unwillingness to work together to solve the problem of the country's debt, we're downgrading it. It wasn't because of the debt, even though it is enormous, and it's a bad thing that it continues to grow. It was more of the management or the people in charge of managing the debt. Now, let's compare that to what we saw from Moody's on these banks. They're now looking at the balance sheet of these banks, so the actual balance sheet, and saying there's some systemic risks to that debt over the intermediate term. So in other words, there's something that could cause something like we saw in February and March. That's the other comparison I wanted to make. Back in February and March, we saw a couple of banks fail, and it was because of the same type of risks that are still out there in the market now. Now, I called it an earthquake back then. When we had these bank failures, it was February, we were rolling towards earnings season, we had failures in the banking system, and it caused an eruption that took the entire banking sector down, and it took it down hard. At that point, I called it an earthquake and said we're likely to see some of these aftershocks in the market for the next 6 to 12 months or so, because it's not something that gets solved right away. There's no magic pill that's going to fix what's wrong with the banking balance sheets right now. This is Moody's coming out and telling us the same thing. They're warning us that interest rates are still high, and the Fed's told us that they're going to be high for longer, and we're also looking at the possibility that we could see another interest rate hike in September. Now, let's go back to that list very quickly, and I'm going to tell you why I call it a wall of worry. Despite the fundamental story out there, which is still that there are some risks in the water for the banks, these banks have taken off. If you look at the returns on the right-hand column of these banks, that is for the last month. So since July, we've seen Pinnacle Financial Partners go up 22%. We've seen Fulton Financial go up 15.3%. We've also seen Webster Financial go up 11%. And if we look down at this list of larger banks, these are kind of your super regionals, it's the same type of numbers. You're averaging around 10 to 12%. To put this into perspective, the NASDAQ 100, which has been the hottest sector out there, it's the sector that has the Microsofts, the Teslas, the Amazons, the Googles of the world. That is only up 0.6% over the same period of time. So you can see what I mean by this market climbing a wall of worry. These stocks are coming off of a relief rally when things didn't get worse over the last earnings season, and we saw some decent reports. Expectations were low, which means it's easier for these companies, these regional banks, to beat those expectations and run higher. That's what you call a wall of worry, when we start to run up and you've got a lot of pessimism in a trade. Here's a chart of the KRE. It's a regional bank ETF. You'll see the just breakneck speed that we have rallied here over July, up about 16%. Again, I'll compare it against the NASDAQ 100, which is up less than 1% for the same period. So you've seen kind of a money migration from one sector to the other. It puts the banks in a little bit of a sticky situation right now. From a technical perspective, the 200-day moving average is just overhead. To give you a picture here, let's look at what's going on with the QQQ that I just mentioned and look at the 200-day moving average here. So your 200-day moving average is way below where the NASDAQ 100 is. And when we broke through that, you can see the support that it gave us to run higher. Remember, simple rules of technical analysis say that when you've got a long-term trend line like this, it can act as support and resistance. In the cube situation, it would clearly act as support. In the regionals right now, it is ready to act as resistance. So that's technical mark number 1 against the regionals. Now, I talked about the slope of hope. That has to do with optimism when it is not warranted. Right now, investors have rallied these stocks 16 to 17% higher on what? There's still some cracks in the fundamental foundation of these companies. So in other words, next earnings season may be a little bit harder. And when you compound it with the fact that a lot of commercial real estate loans are still going to be coming due over the next 6 months and the next year or so, you've got what my friend Shah Galani calls a little bit of a worrisome situation. They're not quite zombie stocks, but there is trouble that is a brewing right now in the regionals. How do you address this? Well, first of all, you listen to Moody's. You look at some of the companies like Huntington Bancorp, like US Bank, and let's look at the ticker symbol of US Bank, or the chart rather of US Bank, and that is USB is your ticker symbol. You'll notice that it is flirting with that 200-day moving average. It's outpaced from a technical perspective the rest of the regional bank sector, but there are still some chinks in the armor here, specifically that commercial real estate equation. As those interest rates remain high, and again, we could get another 25 basis points higher, it's going to be harder for those loans to get refinanced, and that puts pressure on the fundamentals and the balance sheets of companies like US Bancorp. What are a few of the other ones that are on my list? Well, KeyCorp, K-E-Y is a ticker symbol. Right now, that has pulled off. Notice that it did not start to challenge its 200-day moving average. Instead, it pulled up to the $12.50 mark and is now heading back towards a $10 target. Another company that is on the list, and this is on Moody's list, and a little bit of maybe pushback from me, but when you look at Fifth Third Bank, one of the more solidly positioned banks. Sure, they have some commercial real estate exposure. They also have exposure to small to medium-sized businesses. They do a lot of commercial lending outside of real estate, which is slowing down a bit. Still, from a balance sheet and looking at the assets in hand right now, the deposits, which are key for these companies. Fifth Third is one of those companies that continues to outpace a number of the competitors. KeyCorp I mentioned. I also mentioned US Bank. Huntington Bancorp I'll also put on this list. HBAN, another one that is up by its 200-day moving average, and perhaps with the rollover below that shorter-term 20-day moving average and a break below the $12 level, gets ready for a little bit of a slide down to $10. Now, it may not seem a lot, but from $12 to $10, that's cutting it by a sixth, 18.5%. That's quite a move. So as we get looking towards the next earnings season, keep in mind that a lot of these companies that are getting the downgrade from Moody's are kind of been hot. They've been on a run here. 18% is a year's worth of gains for many of these companies, and the fact that they've done it in such a short period of time, again, brings up that wall of worry that they've climbed up. If we see a little bit of a rollover here, I think the other side is a slope of hope, Moody's is seeing some of those long-term risks. From a short-term perspective, I see some of the technical risks. And I think right now, this has gone from being a stock picker's game in the regionals to protecting yourself by either shorting the KRE or the larger banks, the KBE, for this period, especially from August to September, when we see weaker market activity. So summing it up, what do I see from here? Well, I see an opportunity for the regionals to have another bit of an aftershock as we see reports like Moody start to make investors think about the risks that are out there. That leads to an opportunity for cash that has migrated to the sector, driving it up 18% as it climbed up the wall of worry to start pulling out before it goes down the slope of hope here. Where do I think that money's going to go? Energy companies have been on the run again. This is a sector that was lagging the rest of the market. I think you look at the pullback in energy as an opportunity to maybe reassess and pull some of that money from the regional banks. That's been a hot sector that still has some fundamental worries. Other areas, of course, are going to be companies that are in the large cap technology. Palantir just released its earnings. The company pulled back 8% after a good earnings report and guiding things higher. Take a look at Palantir as an option to some of these regional banks. Until next time, I'm Chris Johnson, wishing you the best trading success. Make sure you like and subscribe to get more detailed videos like this on navigating the markets. Have a great day.